Hey guys, in this video I'm going to show you how to trade and scan for QULLAMAGGIE 5-star breakout setups, but this is not going to be a 10-minute fluffy video. It's likely to be 45 minutes to an hour that's going to go very in-depth on these type of setups. Now we're going to come at it from four main areas. Number one, we're going to go into how do you identify these type of 5-star perfect breakout setups? How do you scan for them as well? What is it from a supply and demand perspective that makes these setups so damn strong, and why QULLAMAGGIE refers to them as 5-star setups? Thereafter, we're going to be going through the controlling risk. How do you initially plan out the trade to help create asymmetric risk versus reward trades and really keep that risk in check? Number three is how do you go about mitigating the risk? How do you free roll the trades? I'll take you through some math as we go through some examples as well. And then number four is how do you go about optimizing the profits using moving averages as trailing stops? And I'll show you a couple of my own data research projects as well. Before we get into it, let you know that MarketSmith are today's video sponsor. If you're interested in a discounted trial, then there is a link in the comment section below. And with all of that being said, let's start off with a schematic example where I can illustrate what it is we're going to be looking for. So I'll just show you there's going to be lots and lots of detail, lots and lots of depth on these slides, so I can really kick it about from those four main areas. So let's just start off with this schematic example. What is it you are actually looking for? Well, you're looking to find a stock that has gone up somewhere between 30 to 100% or greater in recent months. This will then all feed into the scanning side of things when we do that in, I don't know, 20 minutes time or something. Look for a continuation base. These are normally 2 weeks to 2 months, building higher lows and respecting moving averages. That could be the 10-day, the 20-day, and the 50-day moving average. You would also like to see tightening price action. Don't worry, we'll explain that in a couple of slides' time. Enter on opening range breakout for the first 1, 5, or 60-minute candlestick, or you can use whatever time frame or combination. You don't have to use intraday charts. Enter when the stock is starting to break out. Stop is always lows of the day and must not and should not be wider than the ATR or ADR. Don't worry, I'll explain all of this of the stock to keep the risk versus reward favorable. Sell 1/3 or half of the position after 3 to 5 days and then move the stop to break even. The rest of the position should be trailed with the 10 or 20-day moving average. Depends how fast the stock is. If a beginner, stick to the 10-day, wait for the first close below the 10-day moving average, and you can go and read this quote over here if you like. So you are basically looking for a stock that is in a powerful uptrend, ideally showing a lot of relative strength. I'll explain the concept of relative strength. Starts going into a consolidation phase, starts building higher lows, respecting moving averages such as the 10-day, such as the 20-day. Now I use the 21-day EMA on my chart, so that's what you're going to see for the blue line when we actually go into the examples. Starts tightening, gets nice and tight as well, and then you can see where these stocks are setting up, and I will explain it and certain type of candlesticks as well. So let's start here. This is PRTS, so let me just read you a quote. Okay, this is a 7-star setup on a 5-star scale. Big move, goes sideways, builds a tight range, look how tight it gets, breaks out, and boom, memorize this. Now you can't see the breakout, you can just see what happened before the breakout. So I'll just take you through how we're going to do these examples. There's maybe 5 or 6 of them that I'm going to break down in this manner, and again, the deliberate nature, the repetition of this by the end of the video, hopefully some of it starts sinking in. So the first slide we're going to look at is this, like as it's setting up in the base before the breakout. The next slide I'm going to show you this is, well, okay, now you've identified it, it's got nice and tight, it's setting up, looks like a good setup. Now what do you do? Like, what do you do? How do you target it? That's what we're going to be going in through. Then the next slide I'm going to be showing you on the 1-hour chart, which is taking you through different order entry techniques such as buy stop limit orders, where to then be placing the stop loss, thinking about free rolling as well, so different free roll levels to take the risk out of the trade. And then I can go down to the 15-minute chart to indicate and explain how opening range breakouts work as well, or opening range highs. It was really Tony Corbell who made opening range breakouts, so I call them opening range breakouts. You can see a recent video on the channel of Toby Corbell's strategy. I'll show you a couple of slides from that as well. So then we'll be breaking it down, so I can then explain the pros and cons of different order entry techniques as well. So here we go. Let's start off with the first one. So PRTS, okay? This is really important. Do you see before, we're not even talking about the base yet, okay? Do you see pre-base? This is pre-base, this trend here. This is very, very key, okay? You need clean setup, something that keeps surfing, that isn't all over the place, i.e. choppy around the moving averages. Now, why is this important? Why am I not even talking about the base? And I'm talking pre-base in the uptrend here, because the best indication of how a stock is going to move in the future is how did it move in the past. So if from a trade management standpoint, you're thinking about using the 10-day or the the 21-day or the 50-day moving average as a trailing stop, it's best to see that the stock respects that moving average pre-base. And you can go back and look at the prior history of the stock, assuming it's not a new IPO, and see, oh crikey, it has actually built these continuation bases, flags, pennants, wedges, VCPs, Darvis boxes, cover, whatever you want to call them, and it's trended out, and it's been a nice clean trend. It's stayed above the moving averages. If you're then looking to trade that stock, it's better to identify those that aren't just chopping around all over the place. Different stocks have to be traded differently. If it's a leading commodity stock, you're probably going to trade it a little bit differently because of how they chop around. So get an idea of the character of the stock. How does the stock move? What is then going to be optimal from a trade management standpoint when you're thinking about the fourth part of the trade, which is optimizing the profits? So why is this ridiculously good? Well, first and foremost, it makes a huge move. Here on the chart, you can see it goes from $2 up to a high of over $9 there, and not a single close below the 10-day EMA. Now it comes down to the 10-day EMA, which is this black line, several times. But you see here, well, it comes down and bounces off of it. Here as well, it comes down and it bounces off of it. Now these are some key candlesticks. I call these shakeout demand tails, because price is going down during the session and then buyers are stepping back in. We've got a dedicated slide on this, gap down, reverse bars, shakeout demand tails, and trigger bars soon. But I'll just give you the concept. Price is going down, it's respecting the moving average, buyers are stepping in. That's a very good indication. Now this bar here looks a little bit innocuous, like, well, it's just a small bar, why are you pointing at it? Well, this bar here is very important because it comes again back down to the 10-day EMA, but price gaps down and reverses. I call this a gap down reversal bar. The prior closes here, gaps down, open here, pushes up, and the volume's low. So the fact that the volume's low says there's not much selling pressure. So this is all just pre-base. We're not even really into the base yet. This is kind of early in the base, right? But these shakeout demand tails and gap down reverse bars around key moving averages are very important. One other thing is you can probably see here on the bottom of my chart, this is the relative strength line. This is not the RSI, this is the relative strength line. They are two very different things. And you can see these blue dots. What on earth are these blue dots? These are 52-week highs versus the S&P 500. So as we go along throughout this slide deck, you're going to see 5 or 6 examples. I've got a couple of quizzes as well, and you'll see 52-week highs. So this is the point about the market does not miss the best opportunities. So if the market does not miss the best opportunities and the market votes via relative strength, focus on the highest relative strength stocks. I'll show you this in terms of the scanning process as well and filtering via relative strength. So 52-week highs pre-base and in the base, really, really strong stock. Then over here, now I'm using a blue arrow because it comes down to its 21-day EMA just about holds above it. Another shakeout demand tail that undercuts recent lows. Imagine these traders trying to get positioned in here, in here, in here, in here, potentially placing their stop losses just underneath these levels, maybe just underneath the 10, underneath $8.50. Oh, shake them all out. Good to see, right? So these shakeout demand tails, gap down, reverse by bouncing off key moving averages, certainly if it's still then building high lows is really good. And then look at the tightness that comes through. And again, it's important to realize, where are you seeing the tightness? So again, doing everything in a very deliberate manner. Where are you seeing the tightness in relation to key moving averages? In this instance here, 10-day EMA, you get multiple tight candlesticks on low relative volume. This black bar here is the 30-bar average going across the volume, okay? So you get low relative volume, tightness in price on the 10-day. Tightness in price, low relative volume indicates there's not much supply coming to the market. Other side of the coin, there's not much demand coming to the market either. But these are the tight areas to be looking for. If you go and watch the Tony Corbell video, and I've got a couple of slides there, he talks about his opening range breakout strategy, but he talks about how he looks for these tightness. Shall I go forward and just show you that quickly? So 3-bar NR and also 2-bar NR as well. So the tightness and price and the detailed data study that he did on this as well. It's really important. I won't now show you this slide again, but you can go and watch the video and understand a little bit more about that. It's the same concept of contraction and expansion, and then contraction and expansion. It's just how the market ebbs and flows. But this tightness price, really, really, really good, okay? But like here, let me just do another example. This bar here, or no, it's not going to be here. This bar here, right? Okay, it does kind of work on this one, but here you get tightness in price, but it's a really short base. Price is wedging up, price is extended from the 10-day. You don't really want to see much distance from price and the 10-day EMA. Like ideally, the 10-day EMA price where you get these really tight bars is sitting on the 10-day EMA, or at least your initial stop is underneath the 10-day EMA, and the risk still makes sense. So now you've identified it, right? And you're like, okay, that's good, but now what do I do, right? So here I'm showing you a couple of things. We've got the ADR of the stock. This is the average daily percentage move of the stock over the last 20 days excluding gaps, which is 5.62%. That is the range of the stock. So we can use that as a metric. I prefer using the ADR percentage versus the ATR percentage. I have ADHD, I have dyslexia, my brain just works better with ADR percentages. It just clicks, it just works better for me, because when I'm working it out as well, I don't think in terms of cents and dollars. I do, but I think in terms of percentages. My brain just works better with percentages. If yours works better with numbers instead of percentages, percentages are still numbers, right? But if it works better with numbers and you prefer the ATR, use the ATR. It's the same thing that you're trying to get to, basically. So we can see here, nice big shakeout demand tail at A1, then at 2B, you've got this gap down reversal bar. At 3C, you've then got this shakeout demand tail, then you've got tight. So targeting it through the high there at $8.84 and a stop loss a cent below the low of that bar would be around about 3%. Relative to the ADR, and again, initial stops ideally are half to 2/3 the ADR percentage. Well, you're under 2/3 versus the ADR. It's good, right? Also, a little quote here. If it's a slow ADR stock, it's you know what. You shouldn't be trading it. Low ADR is equal to you know what. High ADR is equal to gold. Now, when you think about ADR, the ADR of the QQQ over a 20-day period is usually around 1.3 to 1.5%. Can obviously ebb and flow a bit. But if you think about it as kind of 1.5%, if that number sticks better, ideally you want to be looking for stocks with a minimum of 1.5 to 2 times the ADR percentage of the triple Q. So ideally getting closer to 3% ADR and above, and then thinking about the initial stop loss relative to the ADR percentage. It'll make more sense as we do a couple more examples. So now you're looking at it and you're like, okay, now what do I do? Well, there's a couple of different things. So for me, I like using buy stop limit orders. So let me explain the buy stop limit order to you, and let me take you through the free rolling as well. I'll then show you on the next one about opening range breakout. We'll be doing it on the 15-minute chart just to explain it as well. So this would be a buy stop limit order. So okay, great. We've been able to identify it. We're on the 1 hour chart, so we can kind of really dial in here. So this is the prior action, these 7 candlesticks. Okay, this is occurring in this bar here. In the first 1 hour candlestick, nice shakeout demand tail, and then tight. Remember what I was saying about tightness and price, low relative volume, very much supply coming to the market. Little side note, when I drop it down onto the 1 hour chart, I like to see the 10, the 21 and the 50 period moving averages really nice and close together. It's just another little subtle clue, the deliberate nature of things. Okay, so when I'm planning out the trade, invariably I'm trying to buy within 0.5% of the high of what I call trigger bars, those really tight bars. Okay, so how would that order look? Well, I'm looking to buy it somewhere between $8.84 and $8.88, because that would be 0.5% basically from the high of that bar, with an initial stop loss down here, okay, at $8.57, around about 3% risk. That's still favorable relative to the ADR. Now the ADR has jumped a little bit because now we get this wide range bar, which then adds to the ADR percentage. So it goes from 5.62 to 5.85. You can see how the ADR moves when you get more information coming through. So I'm then looking to buy it within this pink zone. So I use a buy stop limit order, which basically means if price trades through $8.84, okay, I then want to get filled no higher than $8.88. That's the limit part of the trade. Now, why is that useful for me? Well, it's useful because I can plan out my trade in advance, which just suits me, suits my personality, and it means I can define and know how much risk I'm going to have on the trade. What is the maximum amount of risk I'm going to have on this trade? Now, why do I know what the maximum amount of risk is on the trade going to be? Because I've defined it. It's $8.88. Okay, my broker's not going to buy shares any higher than $8.88. Now, sometimes it means it can kind of gap above this level and it just goes and you don't get filled. Sometimes it moves really quickly through this level, so you don't get your whole entry order filled. It's nature of the beast. Like, that's trading. It's not perfect. We don't live in a perfect world. Trading is not perfect like this as well. It's often quite dirty. It's in the trenches. And then I know my stop loss is going to be down here at $8.85. So then we want to talk about the free rolling here a little bit. So you'll see that QULLAMAGGIE will refer to, okay, after 3 to 5 days, sell a third to half of your position. Okay, well, is price up 2%? Is it up 5%? Is it up 15%? Are you down 2% but you haven't been stopped out? Should you still sell part? So let me take you through the risk mitigation and free rolling, because that's what that part really comes down to, trying to get yourself risk-free on the trade. So let me take you through a little bit of maths. Now, I use the Fib retracement tool on TradingView and I set it up like this. I have a couple of videos on my platform in the Q&A section for how I set up my TradingView charts and how I use the Fib retracement tool. So here you go, right? We're going to imagine that I get filled at $8.84 and now there's a couple of free rolling targets. We could be looking to free roll here at $9.11, or we could be looking to free roll here at $9.38. So that would be 1 times the stop loss. This would be 2 times the stop loss. For the purpose of this one here, we're going to be doing it by selling 1/3 of the position at 2 times the stop loss, so up here at $9.38. So stay with me while I take you through this example. Appreciate this information. It's coming at you like an absolute fire hose, but by the time we've done a couple of these, hopefully it will make sense. And I, like with all my videos, go back, watch it a couple of times because things will start sinking in. So let's say here, right, you're going to buy 3,000 shares and you get filled at $8.84. So this level here, and you're going to place your stop loss down here in a second. So your total cost is $26,520. Okay, great. We now place our stop loss down here at $8.57. So we have 3.05% risk. So our total risk on the trade, if we get stopped out there, obviously this is hypothetical. It can just slam down, you can get slippage and all sorts. But hypothetically, our total risk on the trade is $810. Why? Because we have 27 cents of risk per stock. So you can see here $8.84 minus the $8.57 would be $27 cents. You see that? So we've got 27 cents times by our 3,000 shares. That gets us to 810. So what we're going to do is I would then use a sell limit order at a specific level. So once the order is then live, I then put in a sell limit order at the level that I'm looking to free roll. So we could sell 1,000 shares with the sell limit order, which is going to be 1/3 of the position. We bought 3,000 shares. We're going to sell 1/3 being 1,000 shares. Now, where are we going to do that? Well, we're going to do it at $9.38. So I then put a sell limit order in here at $9.38 once the position is filled. Now, why would I do that? Well, it's 2 times the current stop loss. We won't get into adjusting the stop loss up. That then brings down the free rolling targets. You can see that in other videos. So that's then going to equal $540 worth of profit if we were able to sell 1,000 shares at this level. So we've now locked in $540 worth of profit. Why is that important? Well, we still have remaining risk on the current 2,000 shares, right? Because we bought 3,000 shares, we've sold 1,000, we still have 2,000. So our remaining risk of 2,000 shares is times by 27 cents. Because remember, we bought them here at $8.84 and our stop loss on those shares is here at $8.57. So now we have 2,000 times by 27 cents, that 27 cents just there equals $540. So we now have profit of $540 locked in with remaining risk of $540 still on our 2,000 shares. So if we take the profit minus the hypothetical remaining risk equals $0. Position is free rolled. Makes sense? So I'll do it in a couple of slides time where we're then going through and we're selling, instead of selling 1/3 at 2 times the stop loss, we're selling half of the position at 1 times to illustrate how this kind of free rolling and that risk mitigation works. So do you see how we're working through the process here? There's 4 distinct parts to every single trade. Number 1, you've got to identify a high quality setup. Number 2, you've got to initially control the risk and create asymmetric risk versus reward trading opportunities. Number 3, you've got to mitigate the risk, free roll the trades as I'm showing you here. And number 4 is optimize the profits, which we'll come on to in a couple of slides time. So let me then just show you another example. Now, this would be using, say, the 15-minute chart and opening range breakouts or opening range highs, whatever you want to call it. So in this instance here, you are looking for the stock to break out. And at the end of this video, I'll take you down opening range breakouts on a 1 and 5 minute chart. With these setups here, I couldn't go back. I don't have the data. TradingView will not go back far enough to get the 1 minute chart and the 5 minute chart. Furthest I could go back and still see it is the 15-minute chart. Okay, so if you were waiting for the breakout and opening range breakout on the 15-minute chart, okay, this is why trading's not perfectly. It doesn't go anywhere. This vertical line here represents a session. So all of this that you see in here, this is the prior session, okay? This is what's going on in here. And then when we're looking at this breakout here, that's what's going on in here. That first 1 hour candlestick is these 4 bars here. TradingView for their 1 hour chart actually has the first 1 hour of trading in the first 1 hour candlestick. Other charting platforms like TC2000, it should actually be a half an hour bar. That's just how TradingView does it, okay? So PRTS, it breaks out here. So if you were using 15-minute chart and going for opening range breakout, well, your entry would then be up here. And what's that, like $9.77, just underneath $9.80. So your opening range breakout would actually be up here. So if you were going opening range breakout here and placing your stop loss lows of the day, well, low of the day would be, what's that, maybe $8.75 down here. That would be 10.38%. Now the ADR is now 6%. Is that favorable risk relative to the ADR? No, because you're really aiming for half to 2/3 of the ADR or ATR percentage, or ADR percentage or ATR number. Does that make sense? So with opening range breakouts, you have to be much quicker staring at your screen. Now, QULLAMAGGIE talks about the 1 minute, the 5 minute, and the 60 minute. You can be using, as he said, whatever time frame you want, such as the 15 minute that I'm indicating here. But yes, you can identify a high quality setup, but sometimes the strongest ones, they will just power out. So that's where the 1 and 5 minute chart could be more effective. because the higher time frames, sometimes like the 15-minute and the 1 hour chart, if it's going to be a really explosive breakout, it can just be gone, and then the risk doesn't make any sense. Make sense? So PRTS. Now, in terms of optimizing the profits, 10-day EMA is going to be the black line that you see in here. So I'm pointing to the first close below. The first close below the 21-day EMA is over here, and then the first close below the 50-day moving average is going to be over here. I'll show you a couple of stats a little bit later on, but in terms of optimizing the profits, 10-day, 21-day, potentially the 50-day as well. My two favorite are the 10-day and 21-day. So free rolling by selling a third or half of the position early on to free roll the trade, and then using the 10-day or the 21-day and or both as trailing stops the remaining parts of the position. So that could be a third and a third, it could be a quarter and a quarter. If it's a really big base and it's got, say, the 50-day moving average, maybe I'll keep some back for the 50-day moving average as well. If price gets extended from the 10, I'll think about choking it off, lower the bar, lower the bar, lower the bar. I'll take you through a couple of examples a little bit later on. If you haven't watched the Tony Crabell video on the channel, I'd recommend you do that. I think it's very applicable to this style of trading. I also covered in recent videos these shakeout demand tails, gap down reverse bars, took you through a couple of the some of the data as well from Thomas Boswolski's book, Encyclopedia on Candlestick Charts. Extremely thorough. I tested about 4.7 million different Japanese candlestick combinations. It's about a 928 page book or something like that. But I'll explain these bars as we go from a supply and demand perspective to really illustrate what's going on. So AMD, okay, AMD. Powerful uptrend coming through here. This is the quote on this specific setup. This is a 6-star setup on a 5-star scale. You've got to memorize this. You don't get many of these. Look how tight it is. Bounces perfectly off the 20-day, then gets really tight. So this here, see how QULLAMAGGIE is? Now I'm using the 21. That's just the one that I like to use on my chart, but they're pretty much of a muchness, okay? They're not obviously in exactly the same spot. Pretty much of a muchness. But when he's talking about here, bounces perfectly off the 20-day. He's talking about this bar here, okay? Now this bar here is also a gap down reversal bar. That's how I define them. But it's also a belt hold bullish, has a very high reversal rating, okay? So this bar here, if you think logically about it from a supply and demand perspective, now AMD is an institutional stock. This is not retail traders doing this. They may be involved, but they're not doing this. They're not creating this candlestick. The prior close is up here, okay, just below $39. Price gaps down to just above $37, okay? Gaps down $37.20 or something, okay? It gaps down here, pushes up, closes strong, and it's a widespread candlestick on a relative basis to what you can see previously. So what's going on this bar? Price gaps down, opens below the 21 in a strong stock that's been in a strong uptrend. It's an area, a vicinity, a region where you'd expect large operators to step up and support the stock. Are they stepping up and supporting the stock? Well, let's go through the bar. Gap down, open near the low, little shakeout demand tail, push up, strong close. That looks like supportive action off of the 21-day EMA, and this bar would not look like this. On the open, it's gapping down here. It looks terrible. Weak hands are panicking, chucking it out. This is why it's called a gap down reverse bar. These shakeout demand tails as well. They're designed to shake out weak hands. These bars do not look like this by the close. That's why employing a Bayesian mentality, update your decision-making process as new information becomes available, is really important. So here you get a gap down reverse bar. What do you notice about the volume? It's not even above the 30-day average. What does that tell you about supply? What does that tell you about selling? There ain't much of it. That's really constructive if it then sets up and then you get this tight inside bar sitting on what moving average? 10-day EMA. Nice. Let's go forward a slide. So now you're like, wow, this 1A bar here, I'm just using this for reference points. I wouldn't call this a 1A bar. I'm just using it to help me illustrate in the video so you guys can follow along. Gap down reverse bar. And then get this really tight inside bar, low volume sitting on the 10-day. ADR is 2.87% at this moment in time. Through the highs, stop underneath the low, 1.46. Okay, nice. We're in that half to 2/3 vicinity of the ADR percentage. We're around about half. It's pretty good. But now what do? How do you enter it? What do you do? Here we go. So if you were to use a buy stop limit order, that's my preferred approach. It also means you don't have to be myopically staring at a screen as well. I just do all of my scanning the night before, and then I plan my trades out for, okay, this is how I'm looking to enter it. I have a life as well, so this is how I'm looking to enter it. I'm going to buy it here, buy stop limit order, put my stop loss there are then my free rolling targets as well. Like if you're using the 1-minute chart and the 5-minute chart, your personality has to marry up with that as well, and you have to be staring at your screen and be very quick on the proverbial trigger as well to be entering these orders. Okay, and an alert goes off, price has just gone through that, well, I got to do that. That may not suit your personality. Maybe slowing everything down does suit your personality. This is why I'm showing you buy stop limit orders, because I love trading these setups, but I'm showing you buy stop limit orders, and then I'm showing you opening range breakouts as well. Okay, there's different ways to trade them. Okay, like there's different setups, there's different ways to trade certain setups as well. Much depends on your personality and your lifestyle as well. Buy stop limit order with stop loss attached. So AMD here, okay? we're going to buy 3,000 shares and we're going to get filled at $39.61. So our total cost on the position is 118 grand. So the buy stop limit order, the way we'll be planning out is 39.61, and the limit within 0.5% of the high of this bar, within the high of this bar here, is going to be 39.80. I don't want to pay any more than 39.80 for any shares. Maybe if I think it's the best setup since sliced bread, maybe I'll push this up to 1%, but I'm controlling the risk. I'm defining my maximum amount of risk. Why? Because I'm defining the maximum amount I'm willing to pay for any shares. Everything is defined. Everything is planned out. So then my stop loss is going to go down here at 39.03. Now maybe because that's just above a round number of $39, maybe I would go down to $32.97 and be a couple of cents below a round number. Maybe, maybe not. But for the purpose of this example, let's work for it. So we've got our 3,000 shares. We've invested 118 grand in this. Our stop loss is going to be at 39.03. So that is 1.46%. In terms of the stop loss, the total risk on the trade is going to be 58 cents. So you can see here 58 cents because we're buying here at 39.61. Our stop loss is here at 39.03. So that's going to be 58 cents, which is 1.46%. So our total risk on the trade is $1,700 basically. 58 cents times by 3,000 shares. Now in this instance here, we're going to sell 1,000 shares again. So we're going to sell 1,000 shares, being 1/3 of the position. Where are we going to do it? We're going to do it at $40.77 up here. This is then our free roll target, given where we're assuming in this hypothetical example that we got filled. So 2 times the stop loss. So our profit now locked in is $1,160, but we still have remaining risk. We have 2,000 shares times by 58 cents risk per share is 1,160. Do you see how the maths is working? So we have a profit of $1,100 minus the remaining risk of $1,100. They cancel each other out, position free rolled, and we still have 2,000 shares now hypothetically risk free. Makes sense? So this would then be 15-minute ORB, so opening range breakout, okay? Now this one here, the risk does make sense on this one. So this is the prior day, okay? That's that kind of trigger bar action. Do you see, you get, those of you who've read Minervini's book, you can see 1 contraction, 2 contraction, 3 contraction, tightening up. Look how the volume dries up. Not bad, intraday action as well. So again, patterns form within patterns. So you get this, what I would call this trigger bar, inside bar on the daily chart, and then going down to the 15-minute chart, 1 contraction, 2 contraction, 3 contraction. Interesting. So it breaks out here, okay? First 15 minutes, it breaks out. Now, if you're using ORB, I've left on the buy stop limit order kind of areas that we were looking at as well, just so you get a sense of different ways to trade these things. So 15-minute ORB would be here, around about $40. So buying it at $40, remember, you'd have to be pretty quick here. You'd have to be watching it. Okay, it's then going. You then got to buy it. You got to decide how you're going to buy it. Are you just going to use a market order, a limit order? What are you going to do? You're going to do a buy stop order through the high. You're going to then do a buy stop limit order off the high there. Again, there's a lot of intricacies here that trading books don't really go into. And then your stop loss on the low of the day, around about $39.20, that would be about 1.92%. Now, is that favorable versus the ADR? Yeah, it is. Under 2/3. Not bad, right? It's around about 2/3, isn't it? Not bad, right? Pretty good, okay? So that would then be a 15-minute ORB. So on PRTS, we saw that it didn't make any sense, that 15-minute breakout and using opening range breakout, because the stop was about 10%. It just didn't make any sense, right? Whereas this time, it does make a little bit of sense, okay? Interesting. Now, AMD, again, look at the black line, okay? First close below is actually here. Even though it's a green bar, it does close below. First close below the 21 is here. First close below the 50 is here. I'll take you through some data a little bit later on, but it's really, for me, how I then think about these setups and trading them is, can I get risk-free very early on, very quickly, and then can I sit for the intermediate term trend? Me and my personality, I'm an intermediate term trend follower, okay? APPS. This is a 5.5 setup on a 5-star scale. Memorize this. Stop makes a big move, goes sideways, surf the 20-day moving average, builds high lows, tight range, high volume breakout. Memorize this. Take a screenshot. You need to learn this. You need to be on these things. So you can see here a little subtlety as well. So pre-base. If you get a really good reaction to the earnings, so this here is a really good reaction to the earnings, gap up, widespread candlestick, opens near the low, strong close, look at the volume coming through, hits a 52-week high as well. It's really good. And then a powerful trend plays out thereafter. Respect the 10, respect the 10, respect the 10, respect the 10. Then you get a shakeout demand tail with a strong close off the 21. Shakeout demand tail underneath the 21. And also look, see how the low of this bar here, okay, if I just draw across, stay with my cursor here, see how the low of this shakeout demand tail here undercuts the lows of the base. Shake out all of those weak hands. What do you notice about the volume? There's not much volume. What does that tell you about supply? What does that tell you about selling pressure? There ain't much. It's a really, really constructive bar to see. Really constructive bar. And then you see how you then get this inside bar that's sitting on the 10 and 21 day EMA. And notice that the breakout is not the high of the base. The breakout's not up here. The breakout is down here, and this is understanding as well the Tony Corbell point about narrow range bars. So he had his 2-bar NR, his 3-bar NR, looking at inside bars as well. Again, I highly recommend you go and watch that video. QULLAMAGGIE, I believe, has read that book and certainly studied Tony Corbell's methods, because there's a lot of things that kind of follow through from that. Opening range breakouts, looking for tight range bars, all of that good stuff, stocking uptrends as well. So this here, tight range bar, low volume, this is good to see, but it's not from the breakout's not up here. Okay, the entry is down here. This takes some people a long time to grasp that the entry, the breakout is not here. The breakout is here. So then you found it and you've identified it. So 1A, shakeout demand tail, 2B, shakeout demand tail, so yeah, undercuts the base lows. Now good ADR, nearly 5.5%. So okay, you've identified it and you've gone, well, the higher the bar is there, the lower the bar is there. So if I'm buying it there, stop loss there, and you get filled kind of perfect execution, 3.5%. Under 2/3 versus the ADR. Pretty good, right? Okay, how do we do it? So again, we could use opening range breakouts. We could use a buy stop limit order as well. So buy stop limit order on this one here, $12.58, and then going in here 0.5%. So the limit on the buy stop order, $12.64. Initial stop loss sent below the low of that bar, 12.14. That'd be about 3.5% risk. Okay, now this time we're going to free roll by taking half of the position off. Now you can see it's actually at 13.01. I would reverse engineer it and push the stop loss up a little bit, so I'd then free roll into the round number. So like 12.98, 12.99 instead of being just above the round number. But for this one here, 3,000 shares at $12.58, our total cost 37 grand. Our stop loss at 12.14 is going to be 3.5%. Stop, why? Because we've got total risk, well, because of where we're placing it obviously, but total risk on the trade is $1,300. Okay, 44 cents, so that's the 44 cents that you see here, times by 3,000 shares. Nice. Now we're going to sell 1,500 shares, which is half of the position at 13.02. I don't know, yeah, that should actually say 13.02, so I don't know why that's not gone up a little bit more, but 13.02, so that's going to be $660 worth of profit. The remaining risk of 1,500 shares is 44 cents times by, what, 1,500 times by our 44 cents of risk, $660. So you can see how the profit cancelled out the risk. So then within the first, what's that? This would be 1 hour chart. So in the first 3 hours and really in the first 1 hour where it's broken out, we've now free rolled the trade. So now we've still got half our position, 1,500 shares, hypothetically risk-free, with our stop loss down here at about 12.14. Maybe we bump it up a little bit to free roll into $13. So now we're there risk-free with 1,500 shares. That's where I want to be, and I want to be there quickly. Take the risk out. Identify, control, mitigate, optimize. So if you were doing opening range breakouts, again, this one here, okay, 15-minute chart, really powerful breakout coming through here. So what you want to see, okay, I call this bullish synchronicity, widespread candlestick, opens on the low, strong close. Look at the volume coming through as well on this bar. So if you were then targeting it on, say, the 15-minute ORB here, well, if you're targeting it through the high, which is about $13, stop loss lows of the day is going to be, what's that, 12.25-ish? That would be 5.71%. Relative to the ADR, well, it's not half to 2/3, it's above the ADR percentage. The risk here is getting out of whack a little bit. Now, 1 minute ORB, 5-minute ORB, the risk probably did make sense on that one there. Maybe 5-minute it would have been half to 2/3 or something like that. So again, using kind of multiple timeframes. As I said, I can't go far enough back in terms of TradingView data to get the 1 minute and the 5 minute, but I'll show you on Oracle later, 1 minute and 5 minute, just to illustrate the point. Apps here. First close below the 10, first close below the 21, first close below the 50. So look how tight the initial risk control is, and then think about that in terms of units that are then being returned for the amount of risk that you've taken. This is what I'm trying to do. Get in, free roll it, sit for the intermediate term trend, let it play out. Stop may go up 5%, 50%, 500%, may stop me out 2 days later. Nature of the beast, okay? Lady luck, variance as they say. NVAX. Perfect breakout right here, 6-star setup on a 5-star scale. So this is a ridiculously good setup. Remember what I was saying about earnings potentially being a catalyst, 52-week highs coming through and a powerful move thereafter. So let's go through, right? 1A, good reaction to the earnings, 52-week highs. 2B, shakeout demand tail off of the 21-day EMA. 3C, another shakeout demand tail. 4D, subtlety here, this is a gap down reversal bar. So the prior closes here, gaps down onto the 21, holds it, tries to rally with this, what I call a supply shoot. Not much volume. Look how the volume's just dissipated. Great. Ridiculously high ADR percentage of 12.48%. Through the high, stop underneath the low, around about 4.75%. Let's take a look at it. So using the 1 hour chart here to illustrate, okay, buy stop limit order. So 55.76, limit being 55.99. Now, for the purpose of the math here, we're just going to assume get filled at 45.76. Now, that would rarely work. Obviously, the liquidity of the stock as well. Is it a Tesla, Nvidia, a Meta, a Google, or something like that? There's much more liquid where you're more likely to get a better fill. Or is it potentially a biotech stock? Is it potentially a smaller mid-cap stock? So this is why you got to kind of think about it as well. And in terms of the trade management, then be thinking, okay, if I'm actually going to get filled at my limit, where are my free roll targets? okay, as well. So then planning everything out, because here, well, I probably, if I'm selling 1/3 of the position, I probably want to do it just under $50, not just above $50, because the market has a habit of moving to round numbers. So here I would then be reverse engineering it and just pushing my stop loss up a little bit to then bring in this free roll target, because obviously if I'm tightening the risk up, my free roll target is coming down as well, because it's then going to be 2 times wherever this stop loss is placed. So I don't necessarily have to free roll off my initial stop loss. I could free roll off a new stop loss if I think it's prudent to do that and push the stop loss up. Interesting, right? So we won't go through this example here because you guys are probably understanding the point of it, but getting in here, thinking about the free rolling targets again on my site, on the Q&A area, I explain fib tool, how I set it up, TradingView charts, and plan the trades out like this, basically. So you can look at that if you want to. NVAX, again, 15-minute opening range breakout. Well, the 15-minute opening range breakout, the initial risk would still be about half the ADR percentage. So in that instance there, it makes sense. Stop loss then lower the day, but then you get this big shakeout demand tail coming through. So see this? Your entry would have been hit. Okay, you would have got filled on this little supply shoot here. Next 15-minute chart, prices come back down, undercut the lows of the day, and then reversed. That's why they're called shakeout demand tails. Interesting. NVAX here, this goes on a huge move. I think it's like 200 and something % here. So again, tight risk control, free roll the trade, sit for intermediate term trends. And for me, it's really about trying to get 5 to 10 of these big winners every year. Like, these are the trades that really move the needles. These ones here, really key. Celsius makes a big move, surfs on the 10 and 21 day EMA, starts building higher lows off the 20-day, takes out this tight range. This is a nice 5-star high tight flag. So you can see this big supply shoot here. What's this supply shoot telling you? Price is trying to go up. Sellers bring it back down, and then respects the 10 over here, kind of off the 20-day-ish in there, but then it does recover. 52-week high while it's still within the base, good sign. 52-week highs pre-base, good. Look how the earnings seems to spark this move as well. What have I been saying about earnings reaction? So 1A, big supply shoot. 2B, a little gap down reverse bar, holds off the 10. 3C, bullish synchronicity coming through, bullish ease of movement. Price easily moves to the upside on not much volume and hits a 52-week high, and then it's back-to-back inside days. And then where is price setting up? Where's it setting up? This is the deliberate nature. Where is it setting up? Setting up on the 10-day EMA. High ADR, nearly 8%. So the initial risk of about 4.5% is nearly half the ADR percentage. Okay, 965 is the high. Penny below, cent below, the lower the bar, 923. Okay. Let's take a look. So if our free roll target was here at 10.47, that would be 2 times the initial stop loss. So this would be the buy stop limit order. You can pause the video, you can read all of this out. I'm not going to do it again and again and again, basically, to save my voice and to save you listening to me. But here's the math if you want to pause the video and take a look at that. Opening range highs, so this would be on the 15-minute chart. So you can see here, it starts moving out. So 15-minute takes out the previous highs of the day at 965. So then the entry would be here. Okay, 15-minute ORB is here. So then your initial stop loss lows of the day, around about 3.96%. That's half the ADR, just under half the ADR of 8.11. So that's unfavorable. Powers out there. How did this trade then play out? Well, this is it in here, and then see, first close below the 10-day is here, first close below the 21-day is here, first close below the 50 is here. So it's all about tight risk control, trying to sit for intermediate term trends. Now, as I mentioned briefly earlier, if I think a stock gets extended from the 10-day, and it's quite like climatic in nature, is like this here. I'll go lower the bar on all or part of the position. It depends. I'm very discretionary in terms of how I do that, how I think the stock is acting. But it's something that I keep open. 5-star setup right here. And again, this is an important quote. Just because it's a good setup doesn't mean it's going to work. That's why we use stop losses. So let's go through it. 2B, what bar do you see here? Shakeout demand tail. 3C, shakeout demand tail, off of the 10. 1A, what have I been saying about earnings potentially sparking a move? So really good earnings reaction. Potentially there's a massive surprise on the earnings or the revenue, or they've just signed a new contract or something is happening, they raise full year guidance, whatever it may be, that the market then reacts to and sparks a really powerful uptrend. And then you start to see the stock acting like a leader, respecting certain key moving averages. How does it respect them? Are there shakeouts? Are there gap down reverse bars? Is there tightness in price? Does the volume drive? Is it a strong RS line? Does it have a high relative strength ranking? Are there 52-week highs? Then you get this tight inside bar sitting on the 10, high ADR of 8.86%, initial risk through the high, stop underneath low around about 6%. So again here, using a buy stop limit order, this is how the trade would be planned out. You could be using half, you could be using a third. whatever. You could then be adjusting your stop loss to low of the breakout day after the first 1 hour and then free rolling off of that level as well. There's the math if you want to go through it. Opening range breakout shown you on the 15-minute chart. So this is the first 15-minute bar, so it breaks the previous high. You got good volume coming through, good bar coming through. So the entry would be here at what's that, $49.30, $49.40. Stop underneath the low of the day, that would be just underneath 46.50. So that would be 5.79% relative to the ADR of now 9%. That's pretty favorable, right? Just over half, but still way under 2/3. So that would then be an opening range breakout on the 15-minute chart, the 1-minute chart, the 5-minute chart, 15-minute chart for illustration purposes. Obviously on the 1 hour chart, your entry for ORB would actually be up here. It would be, what's that, 51.20, something like that up here. Stop loss there, it's probably going to be too wide. You're probably close to an 8% stop loss or so. So very close to the ADR, probably a little bit wide, right? So Fastly, first close below the 10, very bearish bar, that would be the exit in there, and then first close below the 21 is there, first close below the 50, but you can see the tightness and price, see how it sets up in the base. You get a really nice flag that builds in here, little building high lows, riding the moving averages, nice. So let's do a little bit of a quiz now, okay? So we've got ETH, so again, it's commodities, it's cryptocurrencies, it's stocks, it's ETF, it's timeless. This is visually how supply and demand interact with themselves on leading financial instruments at that moment in time. So ETH, can you find 3 5-star setups on this chart? I think there's 3. Okay, so it's really interesting how it moves. Okay, see the stair-step pattern. Where is ETH getting supported? What type of characteristics are you seeing? Are you seeing shakeouts? Are you seeing it's less so gap down reverse bars because of the 24/7 nature of crypto? But are you seeing shakeout tomatoes? Where are you seeing them? Where are you seeing price respect key moving averages? Interesting, right? Ready? 3, 2, 1. They would be the 3 5-star setups for me. One in here, okay, you get a nice big base. Look at this bullish candlestick coming through. Tightness and price, and if there's low volume, tells you there ain't much supply coming through. So really tight bar coming through in here. Powerful move up, pulls down, builds a cup with a low handle. Okay, here's the cup, here's the handle here. Look at the tightness in price. The handle will often represent a Darvis box. Look at the tightness in price. Look at the respect for what moving averages. Price powers up again, pulls in. Look at the respect for the 10-day EMA. Shake out demand tail, tight, tight, tight. Shake out demand tail. There's another breakout. Look at how it bounces off the 21, bounces off the 10. And then when it starts displaying bearish synchronicity, change of character type behavior, Livermore would call these danger signs, warning signs. That's the time to be getting at. That's the end of the trend. Celsius, can you find the 2 5-star setups? I think there are 2 5-star setups on Celsius here. This back in 2009, I believe. Ready? 3, 2, 1. There you go. 1 5-star setup in here. See how the stock powers up here, bounce off the 10, bounce off the 21, gap down reverse bar underneath the 21, shake out demand tail, tight, 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 tight. Look at the tightness, look how the volume dries up. Textbook, moves up, bounces off, and starts finding supportive action around the 21. It doesn't have to bounce perfectly off the 21 every time. It's an area, a region of again, people can get myopic and be like, well, it's got to bounce perfectly off it. No, not necessarily. Like, you can undercut it a little bit and then recover. It's absolutely fine. Like here, well, it does actually undercut the 21, but this is really constructive. Gap down reverse bar undercuts a lot of the base lows. That's shaking out weekends. What do you notice about the volume? The sweet FA in terms of volume. What does that tell you about selling at these levels, supply at these levels? There ain't much of it. It's really constructive if it then sets up there afterwards. And then here's another really good one over here as well. So let's go into a little bit of the screening. So I'll show you this slide and then we'll jump across to my screener and then we'll come back to the slide there to finish off. So let me read this out to you. I recommend you do 3 scans, a 1-month gainer scan, a 3-month gainer scan, and a 6-month gainer scan. You want the strongest stocks on any given time frame. You don't need any intraday scans. All you need to do is use the 1-month, 3-month, and 6-month momentum scan. Find setups by running them after the close, then put good setups in a watch list, then just watch that watch list. That's all you need to do to make millions. So here you go. I'm going to show you a 3-month percentage gainer scan, really simple scan that I just knocked up. If you want to create a little bit more complexity, you can do that, but then I'm going to show you the importance of filtering via relative strength to find the strongest stocks that then meet your trend criteria or your scan criteria. So what we'll do is we'll jump across to my platform and I will show you some of the results from this scan. Okay, we're across on my platform and we're on my stock screen that we call stock screen here. So I'm going to take you through this 3-month percentage gain scanner and show you how super duper quick this is. So we have free plans available, we have paid plans available. On the free plans, I think we have access to these ones in here as well, such as a continuation based screen, which is pretty good, high tight flag screens, volatility contraction pattern screen, all of that stuff. So free plans available, paid plans available if you are interested. So let me take you through this 3-month percentage gain scan. So what are we doing? We're saying country, US, we have access at the minute to US, UK, India, Canada, and Australia. I want the closing price to be above $1. I want price to be above the 200-day moving average. I want the 50-day average volume to be greater than 100K. I want the 3-month percentage gain to be above 50%, and I want price to be above the 50-day moving average. Now we could tweak this. We could use a 1-month percentage gain. We can increase this, decrease this percentage number as well. So we're currently getting around about 64 results. I think with US stocks, we have around about 5,000 stocks or so, ebbs and flows a little bit in our database. So we're looking at some of the strongest stocks in the market right now. Now you can see that we've got this table here. We've got flex charts and we've got charts too. But in this table here, we could now filter via different mechanisms. So we could look at the stocks that have the biggest sales percentage change year over year. So we could look at the highest ones. We could look at the highest ones first. So take a TNGX, for instance, its sales change year over year. It's 150, 153%. There's others 150%, 144%. We could filter by stocks looking at those closest to their 52-week high first. So you can see a couple of coal stocks are looking pretty strong because they're coming up there. CELH, AMR, you got Arch in there as well. Some of the commodity stocks currently look strong. HNRG as well. So if you suddenly see, wow, there's a load of coal stocks coming up very close to 52-week highs, probably means the group's quite strong as well, right? My favorite way to then screen results is actually like this: is come over here to RS rank 3-month, and what I'm going to do is I'm going to select this so I get the highest stocks to the top, which is going to be a 99 rating. Now I think this is the most efficient way to get those stocks that are building the continuation type bases that I've just been talking about and displaying the greatest amount of relative strength. So I think the 3-month relative strength is a real sweet spot. There's RS ranking, we have it on a 1-week basis, a 3-month basis, and 12-month basis. As I just said, I think 3-month is the real sweet spot. Go around, play around with it for yourself. So then I'm going to hit charts. If I hit flex charts, I'll get the earnings and sales data. For the purpose of this, I'm just going to hit charts. Now you can change this from candlesticks, you can change this to bars if you like. You can change the moving average on it as well. You could have 2 per row. You can have a single 1 per row like this as well. So it just makes screening very, very quick indeed. So let me take you through a couple that potentially look interesting. Now my eyes are pretty dialed in, so I know what it is I'm looking for. So this one here, this is AHG. Now issue with this stock is it's only a $1 stock, but in terms of a pattern, breaking out of a big base here, really strong move, pulling in, looks quite interesting. Issue is it's a $1 stock and it's not very liquid. So to filter these out, we could increase that from $1 to say $10. We could increase the 50-day average dollar volume as well. If I wanted to look on the weekly chart, I can do this. So again, it doesn't look a overly good trading stock. Another one here, VRT. Okay, interesting. Good move here. Look at the volume coming through. Look at the volume coming through. Below it's 21-day at the minute. Maybe it can get back. Okay, interesting. Let me keep going, see what else I can find. CLS. Okay, this is looking pretty strong at this moment in time. TTI. Okay, bounce off the 21 here. Bounce off the 21 here. Maybe this is one that I want to be looking at, putting in a watch list. I can come here. I can put this into my watch list here, put it in a preset one, create a new watch list. You can then import these into TC2000 TradingView. If I click this button here, it will take me straight into my TradingView charts and the layout that I have there as well. Let's keep going down and see what else I can find. GTech, okay, really big move here. Bounce off the 20, bounce off the 20. That's not the most liquid of stocks though. EUDA is another one. Okay, interesting move there, but you can see how you can be scanning down. CRNX. Okay, this is interesting. Really big move coming through here. Now looks like it's starting to build a base under $30. Might like the 10-day EMA or the 21 to catch up a little bit, but this is one that I definitely want to have on the radar, so I can just tag it like that. I'll keep going down as I know there's another interesting couple. Tiger. Okay, big move here, starting to base, starting to consolidate around its 21. Okay, interesting. Maybe I want to be flagging this one. So what I can do is just tick that there, do that like that. TOI, okay, 21. Stock's made a decent move here, pulling back in. Look at the tightness. Look at how it's building higher lows. Okay, maybe this one I want to spend a little bit more time on. Not a very high price stock, so maybe I'm going to kind of filter that out. I'll finish with this one. Or these two here. Next nav, this looks interesting. Nice powerful uptrend. Look at the spouts of volume coming through as well. This looks pretty constructive. Want to be having that on the radar as well. Groupon, okay, building a decent sized base, bouncing off the 21. That one there, I want to be having on there as well. So that is literally how quick and easy it is. So you can go and create your own scans. You can use my preset scans. So as I said, we have free and paid plans available. So you can go and check that out if you want to go check that out. And now we'll go across like magic back into the slide deck. Okay, we're now going to start thinking about the fourth part of the trade, which is optimizing. So we've got identify, control, mitigate, and optimize. We're now specifically focusing on optimizing, and I'm going to take you through a couple of data projects that I've done. So below is data from a research study analyzing 500 breakouts and recording the statistics of percentage moves before closes below their 10-day EMA and 21-day EMA. They're the moving averages that I choose to use. The breakout setups included in the study were good, great, and perfect in terms of quality. So that's kind of like 3-star, 4-star, and 5-star if you like. It's better to sell a partial a little bit too late than too too early. Better to sell 10% too late than 100% too early. I agree with that. So here you can see the table laid out here, and we've got our 500 breakouts, and here is the summary. So the average close on the close below the 10-day EMA from these base breakouts, 28.82%, the 21-day EMA 42%. So statistically the 21-day EMA, as you just look at it there in terms of percentages, is better, but as you're going to see, the time value of the 10-day is actually greater than the 21-day and greater than the 50-day. So this is looking at 60 perfect, like 5-star perfect breakout setups from 1976 to 2022. Here is the table here. Here's recording the statistics. So the average initial stop loss about 3.5%. The average 10-day EMA percentage gain, 98%. The 21-day average percentage gain, 148%. The 50-day SMA average gain, 194%. So you may say, well, the 50-day is the best, isn't it? Because it's nearly 100% higher than the 10-day EMA. Maybe it is, maybe it isn't for your personality. The 10-day EMA average days in the trade, 26 days. 21-day, 45 days. 50-day, 72 days. Time value of the 10-day EMA, so the time value of the 10-day EMA is now much higher than the 21 and also than the 50, maybe not much higher than the 21, but certainly than the 50. So 4%, 3.5%, 2.37%. The 10-day EMA reward to risk ratio, so this is then the average, 35, 21, 50, 48, and then the 50-day SMA reward to risk ratio, the average, 56. So there's pros and cons to using different ones. That's why I tend to use the 10-day and also the 21-day, but potentially I'll use the 50, but it depends on the character of the stock. So not a single moving average I think is going to be best for every single stock. That's why I said right at the start of this video, understand the character of the stock. The best indication I think for how a stock is going to move in the future is how did it move in the past. Go and look at prior base breakouts. What would have been the most effective moving average or moving averages to use on that stock? Is it a combination of the 10 and 21, or is it, hey, it's a ridiculously choppy commodity stock, actually I'm just going to sit and use the 50, or I'm going to sit and use the 10-week moving average, which basically the 50-day moving averages are pretty closely aligned, right? So understand the character of the stock. Here's another one as well, okay? So this is a data from a research study analyzing 3,000 breakouts from my model database from 1986 to 2022. So the important part here is, okay, nearly 91%, we'll just say 90% occurred in a month when the NASDAQ composite closed above its monthly 10 EMA. So you see this red line here, you see when the blue line is above the red line. Now this red line here is actually the SMA instead of the EMA, because on Excel I can only get the SMA, not the EMA. But you see, when the blue line is trending above and it is closing above the red line, being the monthly 10 EMA, okay? That is when 90% of the breakouts from 3,000 breakouts in my model database are occurring. So that is breakouts from your favorite books, Minervini's books, O'Neill's books, Stan Weinstein's books, Darvis's book, okay? When are these VCPs, these flags, these pennants, these wedges, when are they breaking? Actually, 90% occur in a month where the NASDAQ composite closed above its monthly 10 EMA. So the longer term trend of the NASDAQ composite for a setup like this, for a methodology like this, is having that longer term trend behind you. It's really, really important. You can go and read the quote here as well about any type of breakout environment or momentum strategy. It's going to work best when the market is in momentum mode. So I kind of think about that as the market above its monthly 10 EMA. Let's go on to another one, and then I'm going to finish this one here with just teaching you about opening range breakouts, and we'll specifically look, because we haven't done it so far, at the 1 minute and also the 5 minute chart. So this is Oracle here, okay? Slow stock, ADR is 1.33%, so it's not going to be the best trading stock, but it's a good example here, okay? Good move here, bounces off the 21-day EMA, nice shakeout demand tail, tight bar, not quite an inside bar, but very tight bar, hits a 52-week high in the base. 52-week high in the base, extreme sign of strength, okay? 52-week highs before the base, really good sign of strength. So now we're going to go and look at this. So now what we're doing is we're going down to the 1 minute chart, and the pivot is here, 95.12, okay? So the 1 minute opening range breakout, you see this bar here is breaking out and it's taking out the range. So people refer to this as opening range breakout or opening range highs. They are the same thing, okay? So then the entry is not here at 95.12, it's then on a break of the high of that first 1 minute candlestick if you're using the ORB on the 1 minute chart. So the entry would be here at 95.33. So you can see how you got to be a little bit quicker on the trigger to get the order in, depending if you're using 1 minute or 5 minute. 1 minute, you're going to have to be even quicker. Okay, stops lows of the day would be 0.52% relative to the ADR. It's pretty favorable. It's under half, right? It's nearly a third. Pretty good. On the 5 minute chart, this is the first 5 minute candlestick. So this is the breakout bar coming through here, taking out the pivot of 95.12. So then the entry is through the highs of this bar at 95.73. So the entry here, stops lows of the day at 94.83. That would be 0.94% relative to the ADR. Is pretty favorable, not bad. This would then be opening range high on the 60 minute chart, so the 1 hour chart. So this time here it's powering out really good. So the opening range breakout would be up here at 96.64. Stops lows of the day would be 94.83. That would now be 1.87%. which is now, what's that, 1.5% versus the ADR percentage. So now the risk versus reward is getting out of whack a little bit, but you can see how on the lower time frames, okay, you have to be much quicker. So does that suit your personality? Can you be looking at the screen? I don't know. That's for you to answer. Now let's go out here. So let's just now finish here. Creating a trading plan. Have a plan, then trade your plan, as the saying goes. So post-market, what are things that you may want to think about doing? This is what I'm doing, okay? Analyze the major indexes, sectors, and groups to determine direction of trends and where there is relative strength. Scanning aimed at finding the highest quality setups as per your criteria. Create a high quality watch list for stock setups of interest for the next session. Plan out potential trades alerts for buy stop limit orders and or opening range breakouts. Check dates for major new catalysts such as the FOMC, CPI reports. Be aware of key earnings reports. Review yourself and your trade management on current open positions such as adjusting stop losses. And I think this part here is why I underlined it. Check in with yourself. How are you? Like mentally, how are you? Physically, how are you? Like review yourself. How are you doing as well? It's really important to obviously review your trades, but review you as well. Like how are you doing? How are you getting on? Keeping yourself in a good mindset, I think, is really, really important when trading. Consider yourself as a top athlete. That is how seriously you need to take this. Pre-market. Do your non-trading pre-market routine, which might include exercise, walking, meditation, visualization, cold plunge. Get yourself in the optimal mindset. As much as you were gonna compete in a sports event, you would probably have a pre-game routine. I really like watching when Rafa Nadal plays, and you'll often see him when they're in the tunnel before they come out on the pitch. He'll be running up and down, and he'll be running up and down in front of his opponent, trying to psych his opponent out. It is his kind of pre-game routine. So as much as athletes, whether it be tennis, whether it be football, whether it be golf, whatever, golfers will go on the driving range, hit their wedges, hit irons, hit driver, do a couple of putts, have a non-trading pre-market routine. What does that include? For me, it includes things like this. This is what I do every day. Check action of major indexes, key market stocks, so the Teslas, the Nvidias of the world, and be aware of significant news catalysts. Is there an FOMC kind of press conference coming out halfway through the session? Is there a CPI report coming out pre-market? You need to be aware of that. Monitoring stocks on your watch list. Market open and during the session, execute your trading plan flawlessly. Like, I'm not looking at social media. I'm literally just trying to execute my trading plan to the best of my ability. That's what I'm trying to do. So I think this is and I do this every single day. Like every day, there's got to be a lot of discipline, a lot of structure, a lot of routine. So create your own trading plan. Like have a trading plan. So that's it, guys. I will wrap it up there. If you made it to the end of the video, very well done. If you did make it all the way to the end, let me know about your trading plan in the comment section down below. Again, I think about it post-market, pre-market, and also during the market as well. So thank you very much for watching, and I will see you in a future video.